Welcome to The Explainer. Today we are taking a really close look at a specialized fund that's trying to do something pretty unique, squeeze a double-digit yield out of the real estate market. It's called RIET, and it was basically built to solve one very specific and very common problem for income investors.
So, let's get right into it. If you've ever looked at one of the big, mainstream real estate funds, like VNQ, you might have felt a little underwhelmed by the dividend. You're thinking, I'm buying property. Where's the rent check? It's a really common frustration, and honestly, it's the entire reason a fund like REIT even exists in the first place.
Here's how we're going to break this all down. First, we'll tackle that core income problem. Then, we'll dive into REIT's unique strategy, see how it actually hunts for that yield, and then take a peek inside its portfolio. Of course, we have to talk about the risks involved, and finally, we'll land on a verdict for who this kind of tool is really for.
All right, first things first. Let's really unpack this problem of yield scarcity. Why is it so darn hard to find a real estate ETF that pays a high income?
This slide right here really gets to the heart of it. You see, the standard ETFs, the big ones like VNQ, are market cap weighted. All that means is the biggest companies get the biggest slice of the pie. And lately, the biggest real estate companies are actually growth stocks. We're talking data centers, cell towers. Now, they've got amazing growth potential, but their dividend yields, tiny, like 2 to 3%. REIT was designed to be the exact opposite, completely ignoring how big a company is to go out and hunt for a yield of 10% or more.
Okay, so if that's the problem, how exactly was REIT engineered to go find all that income that the bigger funds just leave on the table? Let's look at its different approach. The fund was launched back in September 2021 with one really clear mission: an income-first mandate. The entire philosophy is about decoupling the income you get from how big a company is. It's all built on this idea that the best income opportunities are often hiding in the smaller, less popular corners of the market.
And this is the result. This is what that mission delivers. It's a fund that's explicitly built from the ground up to target a dividend yield in the double digits, month in and month out. And that's the headline number that gets everyone's attention.
But hang on. A huge yield can be a massive red flag, right? So how does this fund actually find these high-paying stocks without, stepping on a landmine? This is where its methodology, its secret sauce, is so important.
The very first thing it has to do is avoid this classic mistake. It's called the yield trap. You've probably seen it. It's when a stock's yield looks incredible, but only because the share price is totally collapsed. It's usually a sign that a dividend cut, or worse, is right around the corner. If you just buy the highest yielding stocks, you're almost guaranteed to fall into this trap. So REIT's solution is a quality filter. Before it even bothers to look at a company's yield, it runs a screen for what it calls dividend champions. It's checking for financial stability, looking at debt, the strength of the balance sheet, to make sure that high yield is coming from a healthy business, not one that's on life support.
The whole process is very deliberate. It's all rules-based. It starts by casting a really wide net across this huge universe of real estate companies. Then it applies that crucial quality filter. And only after that does it assign weights using this unique tiered system that keeps any one part of the market from dominating the fund. And this whole thing gets rebalanced twice a year.
And the structure that comes out of this process is, well, it's really interesting. Just look at this breakdown. A full 60% of the fund is intentionally put into small and mid-sized companies, because that's where the highest yield potential is. Then you have these buckets for the stable large caps and those high-quality dividend champions. And you see that last 10%? That's preferred stock. It's in there to act like a fixed income ballast, to try and help smooth out the ride a bit.
So we've seen the rules. What kind of portfolio do they actually create? Well, it ends up making some very specific, and I'd say pretty contrarian bets on the real estate market.
Well, the fund's methodology naturally pulls it toward where the yields are highest. And right now, that's in sectors the broader market has kind of given up on: office buildings, healthcare facilities, and mortgage REITs. This is a classic value strategy, right? Investing where other people are fearful to try and capture that higher income. And its huge bet on the office sector is just a perfect example of this in action. While so many investors have run for the hills because of the whole work-from-home thing, RIET is making this calculated, contrarian bet. It's betting that the highest quality premier office buildings, prime locations, modern amenities, they're not only going to survive, they're going to keep commanding top dollar.
So you can see these key themes really tell the story. In the office sector, it's a deep value play. In healthcare, it's a demographic play, betting on the aging population through companies like Omega Healthcare. And with mortgage REITs, it's a direct play on interest rates, owning firms that basically make money on the spread on mortgage debt.
But of course, and this is a really big but, there is no free lunch in investing. A 10% target yield comes with a significant amount of risk, and that trade-off is something we absolutely have to talk about. And this number right here is the crucial point. While the income is high, the potential for losing your capital is also really substantial. Since it was created, this fund has seen a maximum loss of over 34%. You have to be prepared for that kind of volatility if you want to harvest this kind of yield. And we can actually put a number on this risk. The fund's standard deviation, which is just a fancy way of measuring how much its price swings up and down, is over 20%. And as you can see, that's noticeably higher than its benchmark. That extra volatility, well, that's the price you pay for the higher income stream.
This table does a brilliant job of showing exactly where REIT fits in. Put it next to a broad market fund like VNQ, and it's the total opposite. It's a concentrated, anti-beta play, meaning it's designed to perform very differently from the overall market. And then when you compare it to another high-yield fund like KBWI, you see the key difference. REIT adds that quality screen to try and sidestep those dangerous value traps. It's a very specific tool for a very specific job.
So let's tie all of this together. After looking under the hood at the strategy, the portfolio, and the risks, who is this specialized, high-yield, high-risk fund actually for?
Well, the final verdict is pretty clear. This is a tactical tool. It is not a core holding. It's designed to be a smaller, satellite position in a portfolio, specifically to boost the overall income. So it's best suited for investors who really prioritize that cash flow, who can stomach the volatility we just talked about, and who have a long time horizon. It is absolutely not for the risk-averse. And one last really crucial point. Because most REIT dividends are taxed at your higher ordinary income rate, this fund is way more efficient inside a tax-advantaged retirement account, like an IRA or a 401k. Holding it there lets that high yield compound year after year without a big tax bill eating into your returns.
Ultimately, that's the question REIT really asks. Is the potential for a 10% yield worth the risk of deliberately betting on the most unloved, beaten-down corners of the real estate market? For the right kind of investor, it's a pretty compelling trade-off. For everyone else, it might be a risk that's just not worth taking. Thanks for joining The Explainer.